Have you ever wondered why buying a home has become nearly impossible for regular Americans? The answer lies in the hands of the Federal Reserve of America, and their actions have led to a destructive path for the housing market. Join me as we delve into how the Federal Reserve caused home prices to skyrocket, making them nearly unaffordable, and how their historical interest rate cuts have forever changed the housing market and economy. This conversation cannot be ignored, so buckle up and get ready to have your mind blown. This is how the Fed destroyed the housing market. Even though home prices have come down slightly over the last year, they are still at nearly the highest level of all time. To understand why this is, it's essential to look at interest rates, particularly going back 20 years to post-9/11 and post-dot-com bust America. During this period, Alan Greenspan, the head of the Federal Reserve, made a historic interest rate cut that changed everything in the housing market and the economy forever. This cut occurred right after 2000, when the short-term federal fund rate was 6%. Greenspan cut the Fed funds rate down to 1% in 2003. Since then, the Fed funds rate has only averaged 1.3%. This long-term interest rate suppression has caused home prices to become unmoored and detached from the fundamentals, particularly income and wages. To understand this, we can look at how home prices grew much faster than income and wages in the early 2000s. In fact, the yellow line representing home prices started growing much faster than the blue line representing income and wage. This caused a bubble in the mid-20s and a second one that peaked in 2006. After that, we saw prices crash, and now we're in a situation where prices are still too high, making it challenging for regular Americans to afford a home. To further highlight this issue, we can look at income growth in inflation-adjusted terms over the last 50 years. Income growth has only been 24%, while home prices have grown about 4 times faster than that. This is why it feels so expensive to buy a house, because prices went up faster than income when you're looking at a house, and it feels unattainable. The U.S. housing market has experienced significant changes in the past 20 years due to the Federal Reserve's manipulation of interest rates. Historically, housing prices largely depended on the home buyer's income, which dictated their ability to afford the down payment and mortgage payments. However, the Federal Reserve's suppression of interest rates has caused an influx of people into the housing market, making it more accessible to investors and some home buyers. The resulting demand has caused home prices to increase, as seen after Greenspan's rate cut in 2000. Interest rates remain close to 1% for the next 20 years, allowing housing prices to grow. However, as interest rates rise, prices have started to decline. Unfortunately, many participants in the housing market have become accustomed to the Fed bailing them out during tough times. As a result, many believe that Jerome Powell will pivot and cut rates, making it easier for them to buy and invest in homes. Others believe that the recession won't be as bad as anticipated due to the Fed's rate cuts and stimulus. These beliefs may explain why inventory and new seller listings are down. The largest home builder in America, D.R. Horton, offers homebuyers a special interest rate of 5.25% for a fixed-year FHA mortgage, even though the 30-year fixed mortgage in America is trading at 6.6%. They are accomplishing this by doing expensive mortgage rate buydowns, negatively impacting their profits. Due to these buydowns, their net income has crashed by 35% year over year in the most recent quarter. This approach contradicts the Fed's intention to suppress activity in the housing market and the economy generally. In a rate hike environment and at the beginning of the recession, investors and builders should accept low profits to keep their businesses going. Instead, they are accepting lower profits and returns to keep the sales velocity going and the top-line revenue looking good. This behavior assumes that the Fed will cut interest rates, but this assumption may be misguided. The Fed looks less likely to pivot and cut interest rates. The betting market suggests that the Fed funds rate will only be 25 base points lower than it is today by the end of the year, leaving mortgage rates above 6%. As a result, investors and builders who accept lower profits and returns may start to have problems when shareholders demand higher returns. When this capitulation occurs, it will result in a real sell-off in the U.S. housing market, where investors may start to sell their houses and discount them, especially if the unemployment rate rises. The last housing crash in 2008 had a well-defined timeline. Home sales collapsed in 2007, prices started to dip in 2008, and then collapsed further as unemployment rates surged, leading to a surge in foreclosures in 2009 and 2010. It's important to understand this timeline, as many people have it backward. They think foreclosures caused the housing downturn, but in reality, they were a consequence of it. This is clear when looking at a graph of the Case-Shiller Home Price Index, which started declining in 2006 and had its biggest monthly decline in late 2008. In comparison, the percentage of foreclosures as a share of the total mortgages remained fairly low through 2007, and it only started to increase significantly in 2010, coinciding with the housing market's recovery. Currently, the foreclosure rate in the US is low, but mortgage defaults are starting to increase, especially among low-income, low-credit borrowers who have FHA loans. However, it will take time for these defaults to result in significant increases in foreclosure inventory. They will likely only surge if the unemployment rate rises substantially, such as from 3.5% to 7 to 7.5%. The government has been manipulating the housing market, particularly during the pandemic, by imposing foreclosure bans and forbearance programs that prevented many foreclosures. According to the Biden administration, these measures kept nearly 2 million homeowners in their homes during the pandemic. They even lowered the monthly mortgage payments of some borrowers who had defaulted, which is an unprecedented response to foreclosure. The consequences of these measures is that the U.S. housing market has significantly lower inventory than it did before the pandemic, which has contributed to the current high prices. However, this low inventory could have been offset if the prevented foreclosures had occurred, which would have increased the number of homes on the market. The U.S. government and Federal Reserve have been trying to juice the housing market for the past 20 years by suppressing interest rates and stimulating investment and speculative behavior, but they are now unwinding these measures. This won't happen overnight, and there is a risk that the Fed's attempt to unwind these measures will break something in the housing market, especially if it is forced to pivot due to a crisis or event that causes the unemployment rate to rise sharply. For those who have been waiting to buy a home, it can be frustrating to see the market is still tough and expensive, and it doesn't seem like a good time to buy. The key questions to ask oneself are, how long can one hold out for a price that one can afford, and do you believe that the current gap between supply and demand is sustainable or not? Many people believe that this time is different, and that, due to low inventory and investor demand, housing prices will never come down. However, history has shown that this gap is not sustainable in the long run, and it's up to individuals to decide whether they want to wait for the market to correct itself or take a chance and buy now. And we've come to the end of this video. It now remains to be seen what the future holds for the housing market and the impact that rising interest rates will have. But one thing is clear, the Fed's manipulation of interest rates has had a significant impact on the housing market, and it will continue to be a topic of discussion for years to come. Thanks for watching, and we'll see you in the next one.